Global markets carry a cautious tone into Tuesday with renewed Middle East tensions, rising energy costs, and pressures across global bond markets offsetting the more supportive shift in Federal Reserve expectations. Oil extended its advance after another vessel was reportedly struck while transiting the Strait of Hormuz, reinforcing concerns that the lapse of the U.S.-Iran truce will prolong disruption through the critical shipping route. Brent is trading back above $91, while the U.S. diesel crack has surged to a record above $102 a barrel, raising the risks that higher transport and logistics costs feed into broader inflation. The energy shock is complicating the rates outlook. Softer U.S. employment, inflation, and retail sales data have sharply reduced expectations for a September Fed hike, but oil above $90 and exceptionally high refining margins limit the scope for a more dovish policy repricing. The U.S. 10-year Treasury yield has climbed to around 4.72%, while the 30-year yield closed above 5.3% for the first time since 2007. Japan's 10-year yield has meanwhile approached 2.95%, its highest level in roughly 3 decades. The dollar is holding relatively steady, caught between fading Fed tightening expectations and demand generated by higher yields and geopolitical risk. Euro dollar remains close to recent 2-month highs, while sterling is firm ahead of UK employment data. Dollar yen is back above 159 despite expectations for further Bank of Japan tightening, suggesting the earlier intervention-driven support for the yen is fading. The Australian dollar remains underpinned by the RBA's hawkish posture and an improvement in consumer sentiment, although weaker Chinese data are weighing on the New Zealand dollar and broader regional risk appetite. U.S. equities finished Monday under pressure, with the Dow and S&P 500 both losing around 0.5% and the Nasdaq declining 0.3%. And equity futures are looking lower into Tuesday. Energy and semiconductor shares provided pockets of support, but rising oil prices and bond yields weighed on the broader market. Overall, the market is balancing a softer Fed outlook against an increasingly uncomfortable combination of elevated energy prices, rising long-term yields, and persistent geopolitical risk. That's all for now.